Welcome back to another episode of the Pursuit of Progress podcast. This is Adam once again back with my sidekick and co-host Ben. Ben, good morning, bud. How are you doing today?
I'm doing awesome. It's Friday. Here we are again with another awesome episode and a lot of great things to share. Hopefully, our viewers and our listeners are going to find some value. Really excited about our topic today.
Yeah, I think this is one that we've highlighted a little bit on other episodes. I know you're an expert with a lot of this specific info, so definitely a ton of value to provide our audience. But I'm also starting just to get this coming up in my world a little bit more too. I think just with the real estate world at the moment, with people starting to get off the sidelines and at least start kicking tires, looking at maybe buying a house this spring or this summer, the question comes up about getting pre-approved and, what they're going to be able to qualify for. And the always, important topic of credit comes up. So
Yeah, credit is so important, and the reason that I'm so passionate about this, and we've touched on this in the past, but a lot of these skills, a lot of these personal finance skills, are just never taught anywhere. Financial literacy isn't part of our education system, and your average American consumer really has no idea how to manage their credit and what goes into calculating their scores. So that's why sharing that information and having a podcast like this where we can really go in depth and then also just share some stories from what I see and the mistakes that people are making. Really, really valuable learning lessons.
love it. Yeah, so we have a ton of additional value through videos on your YouTube channel. And that's one of the reasons why I thought this would be a great episode for us to cover today. And on the YouTube video, I definitely recommend everybody checking that out if you haven't already. But you go through basically these 6 tips to improve your credit score. And more than a tip, it's also just really the 6 factors of how your credit score is created and monitored and how it changes over time based on these 6 things. So we're going to do a 2-part series today. So we're going to share the first 3 tips and then stay tuned for our next episode where we'll be sharing the remaining 3. And before we get into some of these stories you're going to share with us and give us a lot of background and just insights on these first 3 tips that we'll go over today, I just want to share a few stats with everybody. As I did a little bit of research before the episode, some of these different things that I was looking into, I just honestly did not know the answers to myself, and they're pretty basic questions. So, I'm going to share a few things with you guys really quick, and then we'll dive into it. But the first thing I was just looking into what even is the range of a credit score. What's the highest number, what's the lowest number, stuff like that. So the highest possible credit score is 850. And Ben, is that correct? I was thinking it was 900, but when I did my research, it was showing up as 850 everywhere I was looking.
850, that's correct.
Okay. And then they didn't really have a true lowest number, but it was being reported it was probably around 350.
That sounds correct as well.
Yeah. And I was, just curious about, how credit is established in the first place. I thought back to when I was in high school. I don't even remember exactly when I got my first credit card or opened my first bank account. I know my bank account must have been probably in middle school after I started babysitting and mowing lawns, just simple stuff like that. But,
Mhm.
I was just kind of thinking through, do you start out with a perfect score and then it can only go down from there when you start having some of these 6 factors, affecting the score. And it turns out that that's not the case. It's really just almost on an individual basis where your credit kind of establishes from day one. And that's based off of what kind of credit you're initially signing up for, what kind of credit card, some of that stuff. Does that
Mhm.
also seem kind of true to what your experiences have been?
Yeah, and that's what's unique about credit is that you literally have a blank slate. So someone that doesn't have credit at all or has never had credit, so someone in high school, for example, or a young adult that's just never had any type of debt, they literally have a blank slate. So what that means, though, kind of to your point, when they start building their credit and adding accounts to their credit profile, their score, because their credit profile is going to be so limited, is going to be very sensitive to what they're doing versus someone who has, a credit profile that spans 20 or 30 years. So that's why it's even more important for younger folks to really understand how to build a very strong credit profile because the actions that they're taking with their credit and how they're using their credit. And one of the biggest mistakes that people make comes with how they manage their credit cards. And
Hmm.
there's a lot of confusion on that and how you actually use your credit card, the balances that you carry as a relation to the limit, the payments that you make, all of that stuff matters. But a lot of times the merchants or the creditors don't explain that. And then, as I mentioned earlier, there just aren't a lot of resources out there. So a lot of people just don't know. They don't understand because they've never had someone educate them. And the system really is kind of rigged against the individual. You think of credit card interest, 20 to 30%. And so you got to, a credit card, when it's used correctly, can be a very, very powerful tool. But when it's not used correctly and if it's mismanaged, it can really have the opposite effect.
Yeah, definitely a very slippery slope. Once you cave into it once and realize, oh, it's okay, I'll just put it on the credit card. That's a dangerous path to go down.
Hmm.
The other part of, just before I move on, is just the confusing nature of credit. I'm 40, and to be honest, I mean, really up until the last maybe 10, 15 years is really when I only started to truly understand some of the stuff we're talking about. As a teenager going into high school, college age, I always also was, taught, credit cards are bad. You don't want to have balances on your credit card, that kind of stuff. So I just always tried to steer away from credit cards, get a debit card type scenario.
Hmm.
And, in fact, you actually do want to have some credit cards, like you're saying, to establish that credit history and actually build it, which is just something that is counterintuitive, I think, it was for me, and I'm sure for a lot of other people.
Yeah, and there are certain, financial analysts and pundits out there that do say that you should never use a credit card and you should only use a debit card. Now, that's not what I believe. I believe that credit cards should be used responsibly. The reason that folks like Dave Ramsey say that is because Americans, they don't have the financial discipline and they haven't built out the financial behavior to use them in a responsible way. So, number one, it is very important if you are going to use a credit card to use it as intended in a responsible way. But when it is used responsibly, there are just so many benefits of a credit card. Not only are you going to have zero liability against fraud, which is a huge impact and huge benefit, but there are, look at your card. And that's what I did. I just logged online and looked at my card. There's actually 35 different benefits. Did you know that one of my cards has complimentary cell phone insurance coverage?
Wow.
If I damage my cell phone, I have complimentary insurance coverage. A lot of cards also have complimentary travel insurance coverage. So if you have a airfare or if you're going on a trip and you've had all these prepaid expenses and the trip is canceled due to inclement weather or health, you're going to get up to like $1,500 back per individual or $6,000 per family. So there are a lot of like little amazing hidden benefits like that. One time I was in Kansas visiting my 90-year-old grandma. I had parked my rental car in her driveway and she ran right into it. And I had just got there like the night before at 2 a.m. I parked the car in her driveway like at 4 a.m. And I woke up at 6 a.m., which was a 2 hour time zone difference. I'm like, what in the world is going on? Like, I just got here and you've run into my rental car. Well, because I made the reservation with my credit card and I turned down the rental car insurance coverage, my card has complimentary rental car insurance. So I did not have to pay a penny for all of that damage. So when you educate yourself on credit cards, when you understand the rewards and all these other hidden benefits, it can actually be a very, very powerful tool, but it needs to be used correctly as intended. And you have to understand how to play the credit card game.
I don't want to go down a rabbit hole, but just one thought that I have that comes up is, you talked about just the rates, how some of these cards are now in like the 28 to 30% APR. I feel like, for the longest time, it was more in like the 15. I was thinking maybe like 18 was like a high APR where you're kind of like, yeah, I don't know if that's the right card for me. I was thinking it
Mhm.
was more in like the teens, you know, that range. But nowadays, man, I don't know. It seems like every card that I see advertised, it's like double that. And it seems like that's only been in the last few years.
Yeah, that's another great question, and we have been in an inflationary environment where
Hmm.
interest rates have gone up across the board. So when the Fed raises the Fed funds rate, really what that means is that all interest rates are going up. Now, a lot of the attention is always given to mortgages, especially because that's the industry that we're in, and that affects the home buying process. But when rates go up, when they go up like that, it affects all types of financing. So that's one reason that credit card interest rates are higher than they would have been a couple years ago. But when you're and another reason that credit card interest rates are higher is because they're unsecured. Something like a mortgage, you think of the mortgage debt, it has collateral, it's secure to a home, a single family residence, or a townhome. An auto loan has collateral, it's secure to the actual vehicle. So those types of debt, because they are secure, they're considered lower risk, and that's why they have more favorable interest rates. With credit cards, there's no underlying collateral. They're considered unsecured debt. So that's one reason that interest rates are typically higher. And then the second reason, to your point, is that just because the Fed has raised rates and interest rates are just higher now than what they were 2 or 3 years ago.
Very good info to have. Thanks. So just a couple last tips, or excuse me, a couple last little statistics before we get into these first three tips today. So the average U.S. credit score today, this is reported as of the second quarter of 2023, was 716. Just for some reference for everybody. Another one is just this idea of a hard inquiry. So a lot of times you just hear these concerns of don't apply for something if you're not sure about it because you're going to have a hard check on your credit or a hard inquiry. I was just kind of curious, how much that really affected a score. And they were saying it's typically about 5 points. It could be as high as 10. So pretty minimal in the big scheme of things.
Mhm.
And then also just trying to find out, like how much can a credit score really improve over a period of time. So, if somebody really takes all six of these tips and segments of how you can improve your credit score, they really just go all in and do everything they possibly can to improve all six of these areas, how much could their score possibly improve? And it seems like it's really based off of the credit score that you're starting out with. And if it's basically a credit score that is, let's see here, typically it's around 120 points in a year. That's more of like a realistic improvement amount. It could be as high as 200 points if somebody's starting off with a pretty low score and they have a lot of room for improvement. But yeah, they're saying typical improvements are more in the about 10 points per month range. So
Mhm.
that's just kind of a benchmark for people to maybe strive to start seeing if they're looking for growth in their score, about 10 points a month if you're doing everything you should be.
Yeah, that's another great point. And the way that I would answer that is it really depends on what the starting point looks like and how much damage that specific individual has done to their credit profile. So, if you have, for example, someone who just has maxed out credit cards, if they have 4 or 5 credit cards and they're all maxed out, well, that's going to destroy their score. But if they don't have any late payments, if they don't have a bankruptcy, if there's no foreclosures, if there's no other collections, it's just maxed out credit cards, well, by paying those balances down, they can actually get their score up literally hundreds of points in a very short time frame if they have the means to do that. Whereas someone who, if they have a more mature credit profile and there's all types of, derogatory items, there's collections, judgments, foreclosures across a wide variety of accounts. For that person, it's just going to take longer because of how extensively damaged their credit profile is. I just always use the analogy. It's just like someone's health. You have your personal health, and then you have your credit health. So someone that is very out of shape, or who hasn't had a healthy nutrition plan, who has not exercised daily, and they haven't done that for 20 years, it's going to take that person longer to get into shape than someone who maybe exercises but doesn't have great nutrition. And so it kind of just depends on what the starting point is. But here's what's encouraging: once you start building that positive momentum, making payments on time, paying credit card balances down, really putting a plan together and start executing that, then at that point, things can change like pretty fast.
So, I always think of bankruptcy as being the most negatively affecting event to happen, mainly because you're defaulting on, the money that's owed to the banks and to the credit card lenders. So you're really kind of sticking it to them. So I can understand why they would want to have pretty sharp repercussions because of that. So I was just kind of curious, how much that affected somebody's credit score. I know there's issues after going through bankruptcy where you are not able to get a new credit card, and some of the risk is more at a point where they just won't even provide you with something, for a period of
Mhm.
time afterwards as you kind of build it up. But the bankruptcy averages, if somebody has a 680 score and they file bankruptcy, typically those are about 130 to 150 point um, adjustments, negative adjustments. And then if somebody has an above average score, let's say 780, they could lose as much as 200 to 240 points.
Mhm.
So just to kind of see what amount of movement there is with that.
Yeah, in the world of credit, there's 4 or 5 different major they're referred to as major derogatory credit events, and these
Hmm.
are events that are considered, a bigger deal. And so, for example, bankruptcy is considered a major derogatory credit event. There's 2 different types of bankruptcies. There's the Chapter 7, which is the liquidation. There's the Chapter 11, which is the restructure. They're both considered large events. You have a foreclosure that's considered a major derogatory credit event. You also have a short sale as well.
Hmm.
So not only will these, derogatory events bring the score down significantly, in the mortgage world, individuals that have had a major credit derogatory event, they are going to be ineligible usually for a period of 2 to 7 years for a mortgage, depending on what type of event it was, what the circumstances were, and then what the loan product was. But in some cases, bankruptcy is just necessary. It can actually be a good thing. Yes, there are going to be some implications. The score is going to go down, um, and that individual probably won't be eligible to get mortgage financing in most cases for at least 2 years. But you're getting a clean slate a lot of times. And so if you're in a position to where you have a lot of credit card debt and you're just overwhelmed, maybe a business didn't work out, maybe you let your credit cards get out of control over the years, it doesn't, a lot of times it can actually be a very positive thing, and it can be a way to reestablish credit in a much quicker fashion than trying to pay all this stuff on your own or hire someone to negotiate. So in some cases, like, bankruptcy is not the end of the world. And, if someone's considering bankruptcy, I always encourage them just to have a conversation with a bankruptcy attorney.
Hmm. So, guys, I'm going to now jump into our 6 little segments, 6 things that affect your credit score. Like I said, we're going to just share the first 3 today. And all 6 of these all have different weighted amounts, percentages that they can affect your score. So, definitely stick around till the end of this episode. The third one we're sharing today is actually what affects it most out of all 6 of these, with close to 40% of the credit score. So, make sure you guys stick around for that one. But jumping right into it, Ben, I want to hear your thoughts on our first of 6 areas. Just some tips on how people can just be more focused on the number one, which is credit inquiries. And this is about
Mhm.
5% of the overall score.
That's exactly right. And I'm glad that you're starting with this one, because this is the number one pushback as a mortgage lender that I always get from customers. And there's just a ton of misinformation in the marketplace online when it comes to credit inquiries. It's almost as if Americans have been brainwashed about credit inquiries. A lot of Americans think that credit inquiries are this huge deal and you should never have your credit pulled. And that is not further from the truth. Let me reiterate a point that you just made. Credit inquiries, it makes up 5% of your overall score. 5%. That's it. 5%. And not only that, for example, if you're shopping for a mortgage and you're looking to get the very best deal that you can, or the most favorable financing terms that you can, or maybe you want to work with someone that's specialized, like, say for example, you need to get down payment assistance, or you're looking to go purchase a parcel of land, something that's a little more unique. Well, you want to make sure that you're working with someone who is a high level expert in that field. And not every loan officer or bank is going to be able to offer that. So in some cases, you may want to talk to several different banks to make sure that you're working with someone that is going to be able to provide high level support with you. But even if you have your credit pulled, it is not the end of the world. And as long as the credit inquiries are within a 14-day window, the credit bureaus will actually batch those and will only count it as one inquiry. So if you have your credit pulled 4 times over a 14-day window with 4 different mortgage banks, that only counts as one inquiry against you. And a lot of folks don't understand that, and they get too obsessed when it comes to not wanting to have their credit pulled. And a lot of that is just because of the online stuff. There's so much information online that's wrong. And then secondly, this is what I always say. You have someone that has spent an entire lifetime, 10, 20, 30 years building their credit profile. They've been responsible. They've paid their debts on time. Well, when it's time to use your credit, go use it. Go put
Mhm.
it to work for you. Shop around, get the best interest rate, get the best financing terms. Don't be hesitant because you're concerned about your credit score. Like, the reason you have a great score is because you managed it correctly. Now it's time to go put it to work. So don't be shy about that.
And that's got to be one that very quickly rebounds. I can't imagine that would negatively affect it for the long term, you know?
Exactly. In my experience, I mean, it doesn't impact scores really, whatsoever. Now, the one exception to that is if you have multiple inquiries with multiple different types of creditors in different trade lines, that's where it can impact your score a little bit more. So, right on the credit report, it's going to tell you the day credit was pulled, it's going to tell you the creditor name, and then it's also going to tell you what type of credit the applicant was applying for. So if someone applies, on the 1st of January, an ABC mortgage company, it'll say, credit inquiry January 1st, ABC mortgage company, and then off to the right, it'll say mortgage inquiry. So if someone has multiple inquiries with different types of creditors, you know, mortgage lenders are considered a mortgage inquiry. Credit card companies are considered revolving credit. An auto loan would be considered installment. So if you have multiple inquiries with multiple different types of credit, that's where your score can be impacted a little bit more. But as long as you're staying in the same trade line, it is not going to be a big deal, and your score likely won't be impacted at all.
Love it. I didn't realize about some of that. So how it could, the different industry, different trades could also affect it. Cool. Let's jump into number two. So number two is even less of the total credits or of the total overall 100%, of the score. This one is being reported at only around 3%. And this one surprised me a little bit. I would have thought this would be making up a little bit larger amount of the overall credit. And this is just the available credit. So talk a little bit on that.
Yeah, this is one that is very, very small, as you mentioned, only 3% of your overall score. And what available credit is essentially it's the amount of credit that has been extended to you that you're not currently using. So it's looked at as a total of all of your credit accounts. So, for example, if you have a credit card and the balance is 5,000 but the limit is 7,000, well, in that scenario you would have available credit of 2,000. But then if you had other credit cards, it would factor that in as well. So what's interesting when it comes to a lot of these scores in these 6 categories is credit cards and revolving accounts. The way that you manage those can actually impact several different categories, and that is why it's so important to manage those credit cards correctly, because it's going to impact your available credit. It's going to impact your total account balances. It's also going to impact your credit utilization rate, which we'll get into later. And so the available credit is just what is not currently being used. And this is one reason why, me personally, I am always trying to get my credit lines extended. Sometimes my credit card companies will do that on their own, but typically every 6 months, I can log into my Chase app or my Wells Fargo app or my credit card app and just request a credit card increase. And I'm not doing that so I can go spend more. I'm not doing that so I can go on vacation. I'm doing that so my available credit will go up, and also it'll positively impact the credit utilization rate as well. So by having increased credit limits, it's going to help you with multiple categories. And you don't ever want to turn down a credit line increase. If someone is offering you a credit line increase, you always want to accept that. Now, the one exception is there are people out there who the temptation is so great. They see their credit line get increased and it's like they can't help themselves and they have to go, well, my credit card limit just went from 10,000 to 20,000. Now I can go spend 20,000. No, that is the wrong mentality. I'm talking about using credit responsibly. I'm not talking, this is not an express pass to go buy a bunch of things that you don't need or go on a vacation that you can't afford. This is about responsible credit card management.
And in addition to credit cards, auto loans, stuff like that, it'd also be a HELOC, right? A home equity line of credit would also be another contributor to that.
That's right. Yeah. And that's one thing that is interesting is that home equity lines of credit, most of the time on the credit report, they will report as revolving accounts. And so that's also one reason why you don't really want to max out your HELOC either, because if you max out a HELOC, well, that's going to impact your available credit and it's also going to impact your credit utilization rate. And if it's not managed correctly, that's going to really have a negative impact on your score. What's different is a home equity loan. So a home equity loan is more like a traditional mortgage where you can't, it's an installment, meaning that it's for a specific term, usually 30 years. And if a bank lends you $200,000 in a home equity loan, well, as you pay it back and as you pay that down, you can't, re-borrow funds from yourself. So, once you pay it off, it automatically closes. Whereas a home equity line of credit, the point of those is that you can constantly pay down and borrow from yourself through your line of credit with your home as collateral at any point. So two very different vehicles, but you're absolutely right that the home equity line of credit is considered a revolving account. And that is something that you want to be aware of from an available credit and credit utilization rate perspective.
And one last question I had about this specific one with available credit. If it's a couple, let's just say it's a married couple or somebody that has like a joint account where there's two people on the credit card,
Mm-hmm.
do they both obviously get affected by positively or negatively managing that card?
Yeah.
Does that entire amount of credit on that card, does that apply to each individual person, or would they take, if a couple shares a credit card and it's a $10,000 limit, would they each add 5,000 to their available credit, or do they each get that full 10,000? Do you know about that by chance?
Yeah, that's another really good question. How it's going to report on their credit report is it's going to report as one account, but then it's going to reference it as a joint account. So I think what you were mentioning is, is it going to be reported as two separate accounts under both individuals? And the answer is that it's actually going to be reported as just one account, but then it's going to be marked as joint. So however that account is being used, and a lot of times, even on joint accounts like credit cards, a husband and wife, it might be a joint account, but maybe the husband is the one that uses the account almost exclusively, or maybe it's the wife. And a lot of times that'll happen. And so, whatever decisions, patterns, and behaviors that the husband is using, well, that's going to impact both of them because it is a joint account. So, whatever the balance is, whatever the credit utilization is, and whatever the available credit is, it is going to have an impact on both of them.
And share a little story about, I know we don't have to go into who it was or, the more details of this scenario, but I've heard, you talk about how there are certain examples that you run into where a family will just basically just put everything, car loans, credit cards, everything just in like one person in their family's name
Mhm.
with, again, not understanding how credit works correctly, where they're assuming that by not having anything in their name, they're in good standing with their credit score. And with reality, they're probably not they have very little to report on in this case, but they just put everything in one person's name. And then that person most likely is going to have a pretty low score because there's balances on all kinds of stuff. And it's not things that he or she has control over because it's his or her name on the card, but it's not necessarily them, using and managing their cards and their balance and all that kind of stuff.
Yeah, it's never ever a good idea, and I've made this mistake myself before, where you co-sign on a loan for someone, or you put someone else's auto loan in your name, or you make someone else an authorized user on your credit card, or maybe you open a credit card and you let someone else use it. I mean, those are all terrible,
Mhm.
terrible ideas. And what you'll see sometimes in the mortgage world is, in some families, one person will kind of be the provider or the income person, and a lot of the income is funneled under this one individual's name, but that individual doesn't have great credit. But then there's this other family member, and they are kind of the credit person, and they have great credit, and everyone, all the other family members put their credit under that individual's name. Well, the problem is when that individual goes to apply for a loan, they have all of this debt in their name that isn't actually theirs. Um, and a lot of times, there in some cases, if things are documented correctly, on auto loans, for example, if you can document that another party is paying those from their own bank statements and paying the auto loan on their own from their own account. In some cases, that can be excluded, but the document, it's very strict. You have to document 12 months worth of bank statements or canceled checks. And a lot of times, because customers aren't knowledgeable with this stuff, they're not setting up the payments in a correct way to really take advantage of some of those loopholes. So what happens is, this one individual can just get overburdened with all of this debt. And then all of a sudden, the auto loan, even though it's reporting in this person's name, well, the brother stops making payments. Well, who is that going to impact? It's going to impact this individual. It's not his auto loan, it's his brother's auto loan that's in his name. So you should never, ever co-sign on debt with anyone. I co-signed on a mortgage with a friend about 5 years ago. I was trying to help him out. I was trying to do him a favor. He was moving out of state and he was trying to kind of get his career going again. And I reluctantly agreed. And guess what happened? It caused a lot of friction in our relationship. We don't talk to this day now. And the mortgage is still in my name, a $500,000 mortgage in my name. Now, he's been making the payments, but I just kind of have this hanging over my head. So never, ever co-sign for someone. It is not a good idea. It's going to destroy your relationship. And, it's a huge mistake. The one exception is if, you're both going to go be partners on a deal and you have the same values, you understand what the risks are, and it's an investment. This isn't so you can go buy $100,000 vehicle that you really can't afford, which that's what it is most of the time. When it comes to cosign debt, think of it this way: the reason that someone needs to get you to cosign is because number one, they actually can't afford it, or
Mhm.
number two, they have a documented history of not paying their bills on time. That's why they need you to cosign. They literally don't have income to support it, or they have a documented history of not paying their bills on time and they have bad credit. Does that sound like a good idea?
Yeah, neither of those are good outcomes.
Yeah.
For any of my entrepreneurial friends, just one last story on this topic. I had a previous business where I kind of bought my business partner out of the deal and just let him kind of exit. And we had a couple credit cards, business credit cards with fairly high balances on them. And even after, having official documents of, proof that I was now 100% owner of the company and he was out of the picture, since he previously had been connected with these credit cards, it was a very sticky scenario just getting this person off of those credit cards to not have it continuing to affect him personally, even though he had nothing to do with, the business. So just thinking of that scenario and being in his shoes, how, frustrating and challenging that would be, where knowing that, you're completely out of something, yet the future of a business credit card could be still affecting you even after the fact. So
Hmm.
just, for the entrepreneurial crowd out listening to this today, just little decisions that you make early on in your business, just building out, the infrastructure of your business, just keep some of
Yeah.
these things top of mind, because simple little things that don't seem like a big deal at the time could turn into some of the biggest, most sticky subjects down the road. So just a little pro tip from my personal experience on that one.
And that is great advice, man. That is great advice.
All right, guys. Well, thanks for sticking around with us. I'm going to share now the third and final of this part one of two series. And this one, as I highlighted earlier, is going to be the most influential of all six of these that we're sharing with you. So number three, without further ado, is just the payment history. And this one is actually up to 40% of the overall score.
Yeah, and that's right. This is by far the most important. And if you asked your average American how her credit score is calculated, the two things they would say is payment history and credit inquiries. And a lot of times, your average American who is not educated on credit or financial literacy, they think that, these two components make up 100% of your score. So, obviously that's not correct. Payment history, though, it is the biggest factor in credit and it accounts for 40% of the score. Now, what's interesting, this is another thing that a lot of people don't know, is that a late payment, as defined by the credit bureaus, if you have a bill that's due on the 15th and you pay it on the 20th, well, that's not considered late. That might be late with your creditor, but from a credit bureau perspective, that's not considered late. It's only considered late with the credit bureaus if it's over 30 days late from the due date. So that's really, really big. I'm not suggesting that you try to not pay your bills when they're due on your credit card statement or your mortgage, but it is something that you want to be aware of. So from a credit reporting perspective, there is a grace period there. Now your creditor can still charge you a late fee. In some cases, if you're late, your interest rate can change. So you want to be aware of that. But when it comes to payment history, it really depends on are the accounts being paid on time? And from a credit reporting perspective, we have unsecured debt, which are things like credit cards, personal loans, and then we have secured debt. We have auto loans, mortgages, home equity lines of credit, home equity loans. Um, if you have a late payment on a secured debt, auto loan, mortgage, home equity line of credit, that is going to impact your score in a much more negative fashion than a late payment on an unsecured debt. And the reason for that is because it's just weighted greater or higher, the secured debt is. And so don't ever have a late payment on a mortgage or an auto loan. Um, Unsecured debt, it's not as critical. Obviously, you don't want to have a late payment there. But again, these are just things to educate yourself and be aware of. You also there's also several different types of late payments. There's the 30-day late, the 60-day late, and then the 90-day late. So if you have 90-day lates, that means that you haven't made your payment 120 days from the due date, and so you don't want to be in that situation. I do see it from time to time. The greater the 60-day lates are going to have a much more adverse impact than a 30-day late. A 90-day late is going to have a much more adverse impact than a 60-day late. And by the way, if you have a 90-day late, well, that also means that you're going to have a 60-day late and a trailing 30-day late. Because if you have a 90-day late, it means you haven't made your payment in 3 months. So 2 months ago is now 60 days late. 1 month ago is now 30 days late. So you actually have three different late payments when you haven't paid your bills, for an extended period of time.
And one tip on this topic for number three here with the payment history is also just really leveraging your automatic payments. So whatever you can get set up with auto pay, just one less thing for you to worry and forget about, or actually, something to not worry about and not forget about is just having as much on auto pay as you can.
That's right. And I'm a believer in that. There are some bills that I like to manually pay because those actually give me joy. Like paying my mortgage, for example. I like to pay my primary residence mortgage myself because I'm always like, yes. But all of my rental properties, my Airbnbs, some of my other properties, all of that is auto pay, and really everything else. All of my utilities, those are auto pay as well. You want to get in the habit. It's not just about it's also your time. If you're having to sit down and call the credit card company and make a payment over the phone, well, that can take 10 or 15 minutes. And it's easy to push that off because you might be working on your side hustle, or the kids are screaming in the background, or you have to make dinner. So to your point, put things on auto pay. It's not going to take up your time. You don't have to worry about it, and it's going to get done.
And then one last personal experience or story I'll share before we wrap up this first part of two on this series. So I, have a background in multifamily apartment, just management and marketing and just a bunch of stuff with apartment buildings here in Denver. And just there are some tools out there. If you guys are renters and maybe you have a pretty limited amount of expenses where you don't have a bunch of credit cards, you just have a very kind of simple lifestyle where you have, three or four things you're renting. So maybe you only have, your internet, your phone, and then most likely your biggest payment is going to be your rent. There are some different tools out there. Some of the property management companies even offer this automatically as a little extra perk for their residents, but there's tools out there that you can sign up for that basically take your rent payments and report those to the credit bureau as an additional way to show consistent payment history. So with something like a rent payment, that's typically not going to be affecting your credit because it's not an institution. It's a landlord. It's just a company that owns the building that's they're collecting your rent. So this is a way to still have a large monthly consistent payment like rent positively affect your credit score. I have a good buddy of mine who's actually the CEO and founder of one of these companies. It's called Tackle. So my buddy Jamie would be somebody you guys could reach out to if you're curious about that. So if you guys are, feel free to shoot me a DM, or I'll also try and leave his contact info in the show notes below.
Yeah, and that's a great point. Just as a final thought here, and that's a great strategy for someone that is looking to aggressively rebuild their credit. Get your rent added. You can also do the same thing with utilities as well, to where you can actually get your Xcel Energy bill, your Comcast bill reporting on credit. You got to make the payment on time, but the more accounts that you can show that you're paying on time, even if it is things that typically don't report, if you can get them on the credit report, which you can, that can help you reestablish credit much quicker.
Love it. All right, guys. Well, I think just in this first part, I think we've already gotten quite a bit of valuable tips for you. I know I even learned a couple new things as well. So with that, we'll close out this first part and have the second episode premiering shortly thereafter. Ben, before we pass it over to you for your closing thoughts, just to recap these top three, guys. So we had number one, credit inquiries. It's about 5% of the overall score. We have number two, available credit, and that's only about 3% of the score. And then for third and final, we had our payment history was about 40% of the score. So we're, concluding this episode, first part of the episode, on right around 50% of the overall score. So don't want to miss the second part because we'll be going over this other 52% of the score with you guys on the next one. Ben?
That's right. Don't let this stuff intimidate you. Educate yourself when it comes to personal finance, when it comes to credit. Remember, you're in control. Take your power back and understand how this stuff works. When you understand how it works, you're in control. You don't have to be intimidated. Learn how to play the credit card game. We haven't even talked about things like rewards, some of the other benefits, but that'll be another podcast. But win the credit card game. Learn how to play this game. Stop paying interest, 20, 30% to these credit card companies. Have them start paying you.
And guys, don't forget, we have lots of other resources on this exact topic. Ben has a ton of really great YouTube videos all about this, diving a lot more in depth with some of these points that we've been making. And then I've also got an 11-week weekly credit boosting program that's totally free. If you guys are interested in signing up for that, you're getting weekly emails with actionable items to take advantage of to try and improve your score over a course of 3 months. So if you guys are interested in doing that, also check out my social media. I've got links in my bios on both of those. It's Adam Lang, or also you can look under Adam Sells Denver. And for Ben's YouTube channel, look up American Money 101.
American Money 101.
Hope you guys have a great rest of your week, and we will talk to you on the next episode of The Pursuit of Progress.
The Pursuit of Progress.
See you guys.